Today is Sunday, the 25th of September, 2011, and on the date, August the 15th, 1971, this is how the gold market looked on the date of the Nixon shock when, well, they apparently went off of the gold standard and let fiat rein in, basically, and well, throughout this time, you had a situation in 1933 where they essentially illegalized the ownership of gold, forcing people to turn it in and robbing people of what little value they had because the price had pretty much doubled up to $35 per ounce. And it stayed there for quite some time here in the 1940s, late 40s. It had a little run higher and then pretty much stayed sideways literally for quite some time. Then in 1968, the markets were trading freely, had a nice run up to 44, back down to 35, starting to go higher in Nixon. The shock begins. Now taking a look at this now to current, we've got a chart that just keeps going higher and higher. I guess you can say that this is correcting sideways through time. Then you have an up run bull market followed by another sideways consolidation, and it's been going up ever since. Now you take a look at this chart, you might state to yourself, wow, we're looking at going from a little under 20 to what we've already touched at 1970, 1920. Now, this is a swing line study. Even though gold is pretty much right around here, the computer is taking the highest level because the market is in an uptrend. However, with that being stated, you've seen a large gain, and that might scare some people thinking, well, if it's up so much, wouldn't it have to sell off? And well, I suppose if what this number represents was stable, then maybe you'd be right. But if we compare this chart to the Dow Jones Industrial Average, this is what we got. The blue line represents 29.2% the value of Dow. Why did I take that number? Because that's the percentage needed back in the third quarter of 1932 to have gold and the Dow worth exactly the same. So from that point on, from the period of September the 30th, 1932 to current, the Dow Jones has overperformed the gold market by better than double, basically. So I find that quite interesting to say the least. Now let's switch this up to the gold to silver ratio. And I have the some dates on here, what the gold to silver ratio was on those dates, as well as the price of gold and silver. And on June the 6th, 1973, the gold to silver ratio was 47 and 2/5, with silver trading at $2.55, gold at 121. Usually when this thing goes down, that means both markets go up, and on here, both markets go down. Well, I guess for the most part, maybe not usually. However, in this example here, within the 6.5 year period from here to here, the price of gold actually went up from 121 to 559, but silver did much better than overperform gold by moving from 2.5 to roughly $40 per ounce. And the gold to silver ratio was 14 to 1 back then. So since this point, since January the 2nd, 1980, we're looking today at silver at roughly around 31. And if you take 9 off of 40, that means that silver's down a little over 20% from this point. Where gold at about 560, well, it's up over 200% within that time frame. So just something a little interesting to just talk about. And again, if you think, well, silver can only go up so much, then why is the gold market went up so much over 80 years? Why is the Dow Jones and so many other things? It's because of money creation and how it's created. So from this point to this point here, which takes us to February 25th, 1991, We've seen the silver price go from $40 an ounce to $3.50, and gold go down to $5.59 to $3.57. So therefore, if you were the type of person that sold your silver around here for gold, and then you're looking at it here, yes, you would have done better off selling it for fiat currency, but you'd obviously get a lot more silver had that happened, even though you held onto an asset that went from $5.59 to $3.57. And then in 1998, there was what was a fake rally in the silver market on a short-term level, which brought silver up to $7.19. So from this point to this point, silver had gone up pretty much double, where gold was actually down about 12%. But it was, again, it was a fake rally. The real thing didn't begin until roughly 2003. Then in October of 2008, gold to silver ratio at 83.79, silver trading at 956, gold at 801. So this was a spot where silver from this point to this point went up about 30%, where gold about 170%. And since this point here to here, we've seen gold pretty much close to double. And then silver go from 956 to 50. That was a major gain. So finally today, where we stand right now, the gold to silver ratio is around 54 to 1. Since this point, we've seen silver go from 48.70 to 31. So it's lost like 30-40%, where gold's up about 12, 13, 15% or something like that. Therefore, as far as these moves, what this kind of tells me is I wouldn't be surprised to see a situation maybe much later on down the road. Maybe we have silver trading in at, say, 130, and say we have gold trading in at 2,800. It wouldn't surprise me to see silver go up to, say, 300-400, and even gold barely go up or even at all, because it depends on the time frame and what the hot commodity is. On the long-term time frame, I'm really not too bullish on gold, only because of its tangible values and how there really isn't too much that it can physically do. Now, granted, these are paper rectangles that this is priced in. It's got absolutely no value whatsoever on the long-term time frame. But as far as this chart is concerned, what we can do is we can draw up some Fibonacci. What we'll do is we'll take a look at the fib level from this level to this part in here, and we'll start that off now. We have a high of 178. So we'll take that high and we'll divide it by the low of 1399. We'll put this number to the power of 618, which is 61.8%. Multiply it by 13.99, which gives us a mark at roughly 47.5. So let me just draw a line at 47.5-ish, ballpark, roughly here. The next Fibonacci level we can do to the power of 38.2%. Again, multiply its low. That gives us a figure of roughly 29.75. So pretty much somewhere within here. So basically what happened is this level was known right in here. Now at this point you never knew if this was going to be the top, because tops and bottoms are known well after the fact. But as it was coming down to this level here, you knew that this was an area of Fibonacci support where it was likely to bounce, and as likely as it was, it did just that. It made a lower high from the previous high. Therefore, when you came back down here, you're not as excited, or you're not as confident that it's going to hold this level, because the more often you test it, the more likely it is that it's going to break. Again, it makes a matching high, not a lower high, not a higher high, and thus when you came down here, it created a double top formation. Based on the length of this pattern, the situation should be taking us to approximately down to 26 to 1. But it did break through this level earlier last year into this year, hit this 31.44, which is pretty much a gram for an ounce of gold and silver, and now it's back up towards here. So we're now in an area. Will we find resistance within this area? The next significant Fibonacci level is from the October 17th high and the most recent low of 31.44. I'll be looking for a 61.8% retracement, and that's most likely the area where I'll consider the likelihood of a top. So we'll take the 83.79 divided by 31.44, put this to the power of 61.8% and multiply it again by 31.44. This gives me a price objective upwards to about 57 2/3. So therefore, roughly somewhere around here is where I'd expect the area to have a top. And as far as how this level works out on previous marks, again, it's an area of a band where this was a support band with the two lines that you see here. It was a support band in here. It was a support band in here. Now the question is, will it be a resistance band as we move further? My ultimate expectation for this is that in the long-term time frame, and it may only take a few years, is for this to not only make a test of this 15, 16 to 1 area, somewhere in roughly around 15 to 1, but for it to ultimately later on to break it and test new levels in the single digits. I don't know if it'll ever get to par. It may not, but I think there's a good chance in the long term that it does get down to below 10. Personally, myself, I'll be looking to get into more gold when it does reach this level, and that of switching silver for gold, because the ultimate outcome is that you probably have some sort of bounce before it ends up going lower. I'm using fundamentals for the reason why this goes lower, and the fundamentals for the uses of each particular metal, with the biased belief that materialism is going right out the window. That's pretty much already started. Thank you for tuning in, and have yourself a magnificent week. Bye-bye.